Okay, let's jump right into episode 4 of the Multi-Major Guardian series. We are looking at the week 23 audit for the GoldMining Guardian strategy, specifically for the year 2026.
And if you've been following our Explainer series, you already know the drill. We skip all the high-level fluff and get straight down into these systematic trading trenches. We want to see exactly how these algorithms are navigating the live markets, day in and day out.
But before we hit this week's hard data, let's quickly reestablish the stakes here. We are tracking a live cent account. This is not a simulation. It started with a very modest 2,500 cents, which, to put it in perspective, is just about 25 US dollars.
Right, and the long-term objective is totally transparent. We are actively targeting that 10,000 cents or $100 milestone. So every single trade, every recovery sequence we analyze, it's all a real, measurable step on that specific road.
So let's look at the raw microdata for week 23. The account generated a net profit of exactly $47.84, which, if you run the math, translates to a very steady 1.1% weekly growth rate. And, in the grand scheme of systematic trading, this kind of incremental methodical progression is exactly what you want to see over a 5-day period. It's absolutely all about compounding those gains. Now, look closely at the weekly balance and equity chart. Notice how that purple equity line slightly separates from the blue balance line?
Yeah, exactly. That gap represents floating drawdown. It naturally increases during active market movement, but the absolutely crucial takeaway here is how controlled it remained. The algorithm literally just allowed the trades to breathe, absorb the volatility, and then close the cycles out in profit. It stabilized beautifully.
And building right on that understanding of risk, the maximum weekly drawdown was capped at just 4.20%.
Which perfectly normalizes that temporary equity pressure we just talked about. Look, in systematic trading, floating drawdown is a standard expected feature. It's not a flaw. Experiencing a 4.20% exposure to secure a 1.10% gain, that shows a highly disciplined risk-to-reward structure.
And honestly, this strategy's efficiency in recovering from that-specific drawdown is frankly outstanding. We're looking at a weekly profit factor of 19.04. That means it literally made 19 times more money than it lost, not to mention a staggering recovery factor of 30.47. It didn't just barely survive that temporary equity pressure, it completely thrived, turning that floating risk into realized capital like clockwork. Digging a bit deeper into the mechanics, the algorithm was quite selective this week, executing exactly 20 trades in total. The euro against the US dollar saw the vast majority of that activity, making up 70% of the executions. But here's the really interesting part. If you look at the net profit, it was actually the US dollar against the Swiss franc that delivered the absolute strongest financial result for the week, despite having way fewer executions. And that actually brings us to a fundamental pillar of this strategy. Rather than relying on a single market to dictate its fate, risk is actively dispersed across the euro, the yen, the CAD, and the Swiss franc.
Right. This cross-market diversification is literally the engine of its resilience. Think about it. When one pair is just ranging sideways, another might be heavily trending, which creates this constant, dynamic balance and active opportunity across the board.
Shifting over to the macro view for a second, what actually drove the markets during week 23? Well, we saw some massive fundamental events injecting serious volatility.
For sure, we had blockbuster U.S. non-farm payrolls data, rapidly shifting Fed rate expectations, and some really sharp movements in U.S. Treasury yields.
And you add in all the ECB commentary, Bank of Japan and Bank of Canada developments, plus your classic Swiss franc safe haven demand. It was honestly a turbulent week for general U.S. dollar strength and global risk sentiment. It's totally fascinating to connect those chaotic global headlines back to the algorithmic behavior. Those central bank shifts in that NFP data directly influenced the volatility profiles of our 4 major pairs. Exactly. And the strategy's response was entirely systematic. No emotion, just adjusting trade frequency, leaning on the euro for engagement, capitalizing on the Swiss franc's movements, and utilizing its recovery mechanisms perfectly to just sail right through that macro turbulence. Now, let's dramatically shift the scale of this explainer from the weekly micro view to the lifetime macro view. Because, while 1.10% in a single week is great, this is what it's ultimately building toward. A truly staggering plus 80.31% total lifetime account growth. This right here is the incredible power of compounding those steady, boring, weekly victories over a long period of time. Let's just read through the irrefutable lifetime stats pulled straight from the platform itself. From that initial 2,500 cents start, the balance has now reached roughly 4,415 cents. That's a net profit of plus 1,976 cents. And over its entire lifetime, it's executed 708 trades with a highly robust 74.01% win rate, all while keeping the historical maximum drawdown strictly capped at just 18.49%. The numbers speak for themselves. I really want you to look closely at this lifetime equity curve, though. Notice that realistic account growth is literally never a perfectly straight line going up and to the right.
Spot on. It naturally involves steps, plateaus, and absolutely periods of floating drawdown followed by systematic recovery. You literally have to endure the dips to achieve the new equity highs. That's just the reality of trading.
And what actually powers that upward curve? Long-term diversification. Over hundreds of trades, the dynamic distribution across the euro, the yen, the CAD, and the Swiss franc is what ultimately fueled the progression from 2,500 to over 4,400 cents.
Right. The strategy doesn't sit there trying to guess which pair will be the absolute best performer over a 6-month stretch. It trades them all, systematically extracting value wherever the market decides to provide it.
So, what is the final verdict for our Week 23 audit?
Honestly, it wasn't a dramatic week. It wasn't filled with explosive gains or terrifying drops.
And you know what? That is exactly the point. It was a complete masterclass in disciplined risk management, steady progression, and tightly controlled exposure. It's these quiet, consistent weeks that truly build the foundation for long-term survival in these markets. Which brings us perfectly to our core channel identity. We analyze this data because we fundamentally believe in transparency. Real accounts, real risk, real progression.
Thank you for joining us for this explainer. As we track this relentless journey toward the 10,000-cent milestone, the ultimate question remains. As global markets brace for further central bank volatility, can the algorithm maintain this ironclad discipline, or will the next 1,000 cents be its hardest test yet? Make sure to join us next time to find out.